Hey everybody, when it comes to stocks, most people regard volatility as the proper measure of risk. Today I'll be explaining what volatility is and why I disagree with that assessment. So first of all, in order to understand why volatility is flawed, we first have to understand what volatility is and how it's measured. According to Investopedia, there are 3 common measures of volatility. There's standard deviation, maximum drawdown, and beta. Standard deviation is simply a statistical measure of how much the price differs from the average. The more the price swings up and down, the higher the standard deviation is. The next measure, maximum drawdown, is a measure of the largest price drop in a given period of time. It just gives a sense of how much downside risk there is by examining prior price movements. Finally, beta is a measure of an individual stock's correlation with the overall market's price movement. A beta of over 1 represents that the stock is more volatile than the overall market, and a beta of less than 1 represents that the stock is less volatile than the market. For a high beta stock, if the market goes up, then the price of the stock would typically go up by more than the overall market. Likewise, if the overall market drops down, then the stock is likely to have larger decreases than the overall market. Now, as you can see, all 3 of these statistics give us a measure of how rapid the price will change. In finance literature, these measures are considered as risk due to the fact that it is hard to predict the actual price. But as a long-term investor, what I want to know is whether this investment will make me money in the next 5 to 10 years. From that perspective, volatility has several issues. First and foremost, volatility tells us nothing about the overall direction we expect the stock to go in. A stock can be both highly volatile and trending upwards. As an investor with long-term objectives, the short-term price fluctuations are irrelevant as long as the stock itself will trend upwards over time. An example of this is Tesla in 2020, where despite being one of the most volatile stocks, the stock almost had a 10x gain in the calendar year. Another limitation with volatility as a measure of risk is that it only focuses on the stock price itself and tells us nothing about the underlying business and whether it will do good or bad in the long run. So for example, the tobacco industry is considered very stable. However, as smoking rates decline over time, the industry faces future pressures of shrinking demand. In the short term, the industry looks very attractive due to the low volatility, but when you consider all these other external factors, the long-term outlook is bleak. If you were solely to focus on these risk measures, you would miss out on all these long-term trends that would have a huge impact on the future outlook of the stock. Now, the last issue with volatility as a risk measure is that it doesn't even properly represent the main risk that long-term investors are even concerned with. So let's give an example. Let's say a 40-year-old decides to invest $10,000 in a risk-free investment at an annual rate of 1.5% per year for the next 20 years. Now, if we were using volatility as a measure of risk, the investor has taken on 0 risk but has made 44% in the process. So that sounds pretty good, but consider this. The average rate of inflation is approximately 2% per year. So the investment is not even enough to cover the rate of inflation, and this would guarantee that you're unable to retire. This inability to meet your financial goals is called shortfall risk, and it's one of the biggest risks that people face with their investments. Too often, people are concerned with simply losing money and lose sight of the fact that they have to hit their financial goals. So without taking enough risk, you can't make large enough returns to even meet those goals. Wrapping up, volatility is commonly used as a measure of risk in the financial world. It tells us information about the price movement and how likely we can predict the stock. However, volatility is not the be-all end-all when it comes to risk. Volatility is just a statistical measure of price movement, and unless you're a day trader or options trader, they don't capture all of the real risks of an investment. Instead, we should be more concerned with the quality and long-term direction of the underlying business you're investing in, and we should focus more whether or not your investment will help meet your long-term financial goals. These are the risks of investing that we should be truly focused on. So that's it for today's video. Thanks so much for watching, and I'll see you next time.